Thanks for clicking. How many interest rate hikes will it take to calm down the inflation rates of both the US and Canada? This has been the question of the day for the past few months.
We're likely to see at least 4, possibly more.
The latest to join the chorus is JP Morgan, which is now calling for 7 hikes this year, up from 5.
I'm expecting still 2 to 4 rate increases throughout the year,
as our inflation rates hit 40-year and 31-year highs, respectively. While many have been calling for and predicting multiple interest rate hikes, with Wall Street predicting 7 in the US and Scotiabank predicting 7 in Canada, others, such as Peter Schiff, have said that so long as our interest rates are below the rate of inflation, we are essentially in a loose monetary policy framework. We are essentially under negative interest rates, where we are punishing people for holding on to their money. We're inducing them to spend. And when you're trying to clamp down on inflation, really you want to reduce spending. You're trying to slow down the economy. So long as the interest rates are below the rate of inflation, this is going to continue. So what I want to do today is go over the past 60 years of the US and Canada's interest rate policy compared to their inflation rate over those past 60 years and see what the spreads were. What did this look like? And how often was the prime rate lower than that of the inflation rate, which is essentially what we have now. Prime rate is 2.45 and Canada's inflation rate is 5.1%. The US's is at 7.5%. So the prime rate is well below the rate of inflation. And we're definitely seeing the results of that as the inflation rate continues to skyrocket. We will have more updates out as we get more inflation data and as we get more interest rate data throughout the next weeks and months and probably years, I would assume. Click like and subscribe if you want to get those updates. But for now, let's get into this data. So let's take a look at first the Canadian interest rate and inflation data over the past 60 years. If we take a look at this data, we can see that at only one point in time did the inflation rate rise above that of the prime rate in Canada, or even get close. We see right here it's at 10.99 was the CPI, whereas the prime rate was 11%, and that was in 1974. Now, I want to note right from the get-go that 1974, right in around that period, was a very, very special case. We had the oil shocks in 1973, which was a major external shock, and it caused the price of everything to shoot right up. Oil is a major input in just about everything. So obviously, following 1973, our inflation rate shot right up, and it did take us a few years to understand how high interest rates were going to have to be to fight that inflation. In fact, if we look after that 1974 point, the spread became consistent again, and we see that the interest rates went sky high. Prime was at 18.25 in 1980. Inflation was at 10.1 right in 1980. And then as we move all along the curves here, we can see that the prime rate was always higher than inflation right up until directly after the 2008 crisis in 2011. And even that, they were basically the same. And then right up until now, we don't have 2020's data listed on the Fed. Right up until now, we can see that that spread has maintained. In fact, when we average out all of the data, we can see that that spread, the difference between the prime rate and the rate of inflation in Canada for the past 60 years was 3.45. So on average, the prime rate was 3.45 higher than the rate of inflation for the past 60 years. To put that in perspective, right now, our rate of inflation is 5.1%. So that would need to put our prime rate at just over 8%. And our prime rate right now is at 2.45%. So that should give you an idea of how far away we are right now from the spreads of the past 60 years. And that's not just Canada.
You're not special!
If we take a look at the US data, we're going to see a very, very similar pattern. So looking at the US data, we see very, very similarly. We see that the prime rate was always higher than the rate of inflation right up until 1974. Again, this was large part due to the oil shocks, to the formation of OPEC, and the price of oil going up sky high. But following 1974, we see that the prime rate shoots right up to 1981, very similar to Canada, shoots right up to 18.87, and the inflation rate was 10.3. So just in 1981 alone, we see that that spread is almost 8%, similar to Canada. Now, if we look back after that, the spread continues right until 2011, right after the 2008 financial crisis, and then that spread continues again. So just like Canada, we've only had very, very small amounts of times right now and in 1974, right after OPEC, right before stagflation, where the interest rate was lower or even close to the rate of inflation. When we average out the U.S. prime rate spread versus the inflation rate over the past 60 years, again, we hit at 3.41%. 3.41 and Canada's at 3.45. That's a fairly consistent spread from two very different countries, two very different economies, closely linked, but very different in their composition, in their reliance on resources, in their standing in the world. Two very, very different economies on those metrics, and we still see a 3 to 3.4% spread in between their prime rates and the rates of inflation, with the prime rate always being higher than inflation, except for 1974, and it came close in 2011. Again, very, very close thereafter, major international crises. Not that we're not in the aftermath of a major crisis, but we did see in 1974, following the sky-high inflation that went up and up and up, we saw that spread continued major, and that spread also continued after 2011. Even after 2011, we can see that the inflation rate went low, and the prime rate was well above it. And I mean, the reason for this is very simple when we look at real negative interest rates. If you have $100 and you know that next year your purchasing power is going to be $95, you're going to spend that money. On the other hand, if you have $100 and you know that that same 100 is going to be able to buy you $105 next year, you might save that money. So higher interest rates encourage saving, lower interest rates encourage spending. Right now, we have too much money in the economy. We have too much spending going on, which is pushing prices up and up and up. And it's for that very reason that interest rates for the past 60 years have been higher than the rate of inflation in both the U.S. and in Canada, two very different economies. And it's because higher interest rates tamp down on inflation. Higher rates keep inflation lower. Now, we have heard for the past 12 months, 18 months, that the inflation rates we've been seeing are just transitory.
Fed Chair Jay Powell reiterating that inflation has increased notably in recent months, but does remain transitory.
Is inflation really transitory?
Then a few months ago, the Bank of Canada and the Federal Reserve just dropped that word, saying it wasn't going to be so short-lived.
It's probably a good time to retire that word and try to explain more clearly what we mean.
Transitory but not short-lived.
Now we're talking about supply chain issues, and we're talking about Omicron as reasons why our inflation continues to go up. And all the experts are predicting that we're only going to need to have between 4 and 8 interest rate hikes over the next 12 months. But this data seems to show something much different. Even if we get those 8 rate hikes, even if our prime rates go up to, say, 4.45, given that inflation's already at 5.1% in Canada, 7.5% in the US, these charts that we just looked at showed that those interest rate hikes will not be enough to get a control over inflation. Interest rates need to be higher than the level of inflation in order to discourage that spending. If interest rates are not higher than the rate of inflation, we are in real negative interest rate territory, which encourages spending. $100, would you rather have $95 in a year, or would you rather have $105 at the end of the year? One is going to encourage you to spend, driving up demand, driving up the rate of inflation. One is going to encourage you to save. With that said, maybe all the experts are right. Maybe this is a supply chain issue. Maybe once the vaccines are completely rolled out, maybe once Omicron and COVID is behind us,
maybe, baby,
everything will return to normal. But the past 60 years of interest rate policy and the inflation rate in both the US and Canada does seem to paint a different picture. With that said, we will have updates out on the Bank of Canada and the US Federal Reserve as our rates of inflation continue to go up and up and up, and whether or not and how high our interest rates will go up to tamp down that inflation remains to be seen. So we'll have all those updates. Click like and subscribe if you want to get those, and thanks so much for watching.